just to recap, I had this article that I read, and they were talking about mortgage notes are discounted because of the time and value of money. And I 100% disagree with that. I believe that they are discounted because of the risk and the required yield. And so, reading that article, it just really prompted me to, put together this PowerPoint presentation for my 5 minute-ish Friday. So, once again, the common belief is that, notes are discounted because of the time and value of money. Excuse me. In my opinion, this is a textbook finance answer. It assumes payment certainty. It ignores real world risk. And, a question, just real world, right? Would you rather have $100 today or $100 in a year? The textbook logic, real world is different from, the belief that, notes are discounted because of the time and value of money. So, in my opinion, the real reason notes are discounted because investors demand yield, and yield reflects risk. There's no risk, you're actually just getting a lower yield, right? More risk, higher yield. Yield determines price, and price reflects uncertainty. You are not buying math, you are buying uncertainty. So I'll get into this with the risks and things like that. But before I do that, yield and price, they move opposite to each other, right? So the higher the yield, the lower the price. The lower the yield, the higher the price. So investors price for protection, and that's what I do, right? I have a yield, an investment to balance, and loan to value that I like to be at. And so all of this comes into play, and all of that comes into, it does not, for me personally, it does not come into time value of money. It boils down to risk. So margin of safety drives returns. The competition affects the yield, and market condition resets the pricing. So of just few risk, interest rate risk. If market rates rise, the required yield rises. And if required yields actually rise, note prices fall. New deals offer higher returns. Buyers demand more yield. Existing notes must be repriced, and price adjusts to compete. And once again, it's not about the coupon rate. It's about the yield the buyer requires, right? So here's an example. So if, say, you have a note that pays 6,000, and I'm just taking this, take the 6,000, divide that by your yield. This is the cash on cash 1 year, right? This isn't the yield to maturity. This is just simple cash on cash. So if you take that and you're looking to make 6% yield, that note's going to be worth $100,000. But on the same token, on the other side of the coin, I should say, if you're looking to make a 13% yield, you're going to be paying about $46,000 for that note. So same cash flow, different required return. Yield changes forces price change, right? So that's a rate risk. Collateral risk, property's value change, market shifts. You have repair costs, tax increases, loan to value comparison. If the equity shrinks, your risk increases. You have borrower risk, right? So payments can stop, job loss, health events, divorce, strategic defaults. No payments mean legal costs and delays. And I'm actually going through a foreclosure on one of my notes right now. So, I'll be doing a case study on that here shortly. So you have liquidity risk, right? Notes are not always easy to sell. Then secondary market, buyer demands discounts. Exit timing uncertainty, cash is locked up. Liquid assets require a yield premium. And so, this just really leads me into the final, when I have this conversation with sellers of notes, what sellers actually need to hear. I hear it often that, that the time and value of money, that's why you're getting a discounted, rate and, all this other stuff. I simply tell them I price based on risk and require yield, right? So my buy box, the risk sets the yield sets the price, and the market sets the required return. Smart investors protect the margin. So the big takeaway on this is when rates rises, required yields rise, right? So when required yields rises, the price falls. So notes trade on risk, not theory. And if you have any questions about this, please feel free to contact me. You can email me if further clarifications. Please feel free to give me an email, Larry at ljhinvestments.com. Visit my website. You can give me a call, 513-301-1468. You can actually get on my Calendarly link, talkwithlarryhoffman.com. We can, schedule a time that works best for you. Maybe, this topic is a little foreign to you, or maybe you just have some lazy assets that you're looking to put to work. You can just book a time. Or if the note investing is totally foreign to you, you can join my free school community at thenoteprospectors.com. Please feel free to join up. It's 100% free. Or if you want to book a time with me, let me move this window over here so I can see. If you want to book a time with me, you can go to talkwithlarryhoffman.com. That'll set you up on a Calendarly link. We can spend 5 minutes, 30 minutes, or an hour going over, anything mortgage note related, real estate, or even, like I said, if you're looking to put some lazy assets to work, please feel free to reach out to me.